Welcome to Managing the Future, the MIS podcast.
Great to be here.
Today, we're really diving deep into Module 24, blockchains and cryptocurrencies.
Yeah, a big topic.
Absolutely. And this is crucial stuff for, any Dr. Sam Pat College of Business student, or really anyone tuned in who's interested in management, business ops, IS.
It touches everything eventually.
It really does.
Yeah.
So our mission here is to kind of cut through the noise, the complexity.
Get to those aha moments.
Exactly. Give you a clear, practical understanding of this, transformative technology. We're putting the key insights from Richard Tedmon and Casey Wilhelm's Connect Master, Management Information Systems textbook.
And it's true, right? Most of us, we've heard of crypto. Maybe you've even, put a little money in.
Maybe.
But the thing is, the tech underneath it all, blockchain, that's way bigger than just digital money. It's really set to reshape industries pretty much across the board.
Totally agree. And you might be sitting there thinking, okay, but how do you even buy crypto?
Right. Or how does it even have value?
Yeah. And what are the real risks? We hear about those a lot. And crucially for our listeners, how does this connect back to actual business operations?
Good questions.
So this deep dive, we're aiming to help you understand not just what blockchain is, but how it works, how it's made.
Why it matters for the future of business.
And how to navigate it all, right?
Right.
The challenges, the opportunities. We'll also demystify the jargon of different cryptos, how you store them, access them.
And definitely talk about managing those risks with your eyes open.
Exactly. A well-informed perspective is key.
Okay.
So let's get into it. Segment 1.
Unpacking the foundation. What is blockchain technology?
Okay, let's unpack this whole thing. We have to start at the beginning, right? The foundation, blockchain technology.
Mm-hmm.
So what is it, like, at its absolute core? And, how did we even get here?
Well, think of it like this. It's a bit like how gold keeps its value, okay? It's relatively rare. It's hard to change or counterfeit. Blockchain kind of builds on that idea digitally. Once a blockchain is built, you can add new links, new blocks to the end of the chain.
Wow, yeah.
But the existing chain, you can never alter it. It's fundamentally immutable.
Immutable, like set in stone digitally.
Exactly. And that permanence, that unchangeableness, that's what gives it its core value, especially when you attach things to it like cryptocurrency.
So super secure, permanent digital ledger.
Yeah.
Got it. What was the spark? How did this idea come about?
Well, the history actually has parallels with how the internet itself works, packet switching.
Breaking data into small pieces.
Right. Blockchain does something similar conceptually. It creates these blocks in a chain. And each block contains basically 3 key things. A unique code, like a digital fingerprint, called a hash.
Okay.
A timestamp showing exactly when it was created. And critically, the unique hash of the block that came right before it.
Ah, so they're linked.
Precisely. They're cryptographically linked. That interconnectedness means if someone tried to tamper with an old block, its hash would change.
Which would break the link to the next block.
Exactly. It would invalidate the entire chain from that point forward. Instantly noticeable.
Clever. And the first big one, the one most people know, came out in 2008 for Bitcoin, right? That's kind of where it hit the mainstream consciousness.
That's the one. Now, when we define a blockchain, especially a public one like Bitcoin or Ethereum, the textbook highlights 5 fundamental attributes. You really need to grasp these to see why it's powerful. It's not just one thing, it's how they fit together.
Okay, lay them on us.
All right. First, the blocks themselves. We just talked about those. Hash, timestamp, link to the previous block, added at regular intervals.
Got it.
Second, they're permissionless. Think Bitcoin, Ethereum. Anyone can join, anyone can participate. It's all on a public ledger. No gatekeepers.
Okay, open access.
Third, and this is huge, no centralized controlling authority, no single bank, no government, no company is in charge of validating things.
Decentralized, that's the key word.
Absolutely. Fourth, there's a standard protocol. The rules for how blocks are built, how transactions are verified, they're established, transparent, often global standards.
So everyone plays by the same rules.
Exactly. And fifth, probably the most crucial part, the consensus mechanism. This is the method the network uses to agree that a new block is legitimate before it gets added.
Ah, so that's how it works without a central boss.
Precisely. It removes the need to trust some outside entity. The trust is baked into the system itself, into the consensus.
Okay, this is where it gets really interesting for me. These consensus mechanisms, how the network actually agrees. We hear about proof of work all the time.
Right, the original.
But there are others, aren't there?
Oh, yes. And choosing one is a fundamental design choice. It impacts speed, energy use, security. Let's break down the main ones.
Please do.
Okay, proof of work. Bitcoin uses this. Ethereum used to. It involves mining.
Mining. Solving complex math problems.
Exactly. Requires massive amounts of computing power. The first miner to solve the puzzle gets to add the next block. They put a little piece of data, a nonce, on the block to prove they did the work.
Okay. But the downside?
Huge energy consumption, really significant environmental concerns.
Right. So what's the alternative?
Well, a major one is proof of stake, POS. This doesn't need all that computing power. Instead, people who already hold the cryptocurrency can stake some of it, basically putting it up as collateral.
Like a security deposit.
Kind of. The more you stake, the higher your chance of being chosen to validate the next block and earn transaction fees. It means faster transactions, much less energy.
But does it favor the rich? People who already have a lot to stake?
That's a valid critique, yes. It can potentially centralize validation power among early or wealthy investors.
Interesting trade-off. Any others?
Yep. There's proof of authority, POA, or sometimes proof of state authority, POA. These rely on a smaller, known set of pre-approved validators. Think of them as trusted entities chosen to certify new blocks.
So less decentralized.
A bit, yes. You often find POA on private or consortium blockchains used by businesses, like, say, Microsoft blockchain. It offers efficiency, but sacrifices some of that pure decentralization.
And are new methods still popping up? This field moves fast.
Incredibly fast. We're seeing things like hybrid consensus authority, mixing different methods.
Okay.
Proof of history, POH, which focuses on verifiable timestamps for super fast validation. Solana uses something like this. Proof of contribution, PC, a variation of POS looking at who contributes most effectively. And even proof of burn. Yeah. Miners actually have to destroy or burn some existing tokens to get the right to mine a new block. It reduces supply, potentially increases scarcity value.
Wow. Okay. Lots of different ways to build consensus.
Beyond currency, the broader impact and future of blockchain technology.
All right. So we've got the basics of blockchain down. The blocks, the chains, the consensus. What does this actually mean for the bigger picture? Especially for, business students listening. We know it enables crypto, but what else is it good for?
That's the million-dollar question, isn't it? What's the real broader impact beyond just digital cash? So yes, blockchain allowed for decentralized currencies like Bitcoin. And Bitcoin's value, like we said, it's not set by a bank.
It's set by the market, by investors, like gold.
Exactly. It's primarily a store of value, a medium of exchange, although a volatile one.
But then teams like the Ethereum developers came along and thought, bigger.
Way bigger. They looked at the blockchain and said, hey, this immutable ledger thing, we can use it for more than just tracking money. They realized you could create immutable smart contracts.
Smart contracts. Okay, we hear that term a lot. What does it mean practically?
Think of it as self-executing code, an agreement written directly onto the blockchain. Once it's deployed, it runs automatically when certain conditions are met.
Like an if-then statement.
Precisely. If party A pays X amount, then release the document to party A. And crucially, because it's on the blockchain, you don't need to trust a middleman, a lawyer, an escrow agent, a bank to make sure it happens.
No intermediaries needed. That sounds like a game changer.
It absolutely is. It fundamentally changes how agreements can be made and enforced.
So looking forward then, where is this tech heading?
Sure.
Where might we see blockchain really making waves in business operations? Based on what the textbook suggests.
The potential applications are, well, they're vast. Let's throw out a few concrete examples.
Okay.
Supply chain tracking. Imagine tracking food products. If there's a contamination scare.
You could trace it back instantly.
Exactly. Pinpoint the source in minutes, not weeks. Think about the savings in cost, reputation, even lives. Or tracking ethically sourced diamonds, proving provenance from mine to retailer. Blockchain gives you that unalterable, verifiable record.
Makes sense. What else?
Healthcare. Huge potential here. Securing electronic health records for one, making them tamper-proof but accessible to authorized people.
Better privacy and better access for doctors.
Right. And think about pharmaceuticals. Tracking drugs to ensure outdated meds are pulled immediately, fighting counterfeits.
Okay, yeah, I can see that. And finance.
Yeah.
You mentioned cutting out intermediaries.
Financial services is probably where the disruption could be most profound. Those smart contracts we talked about. They could automate huge swaths of what banks and insurance companies do today.
Like loans, insurance claims.
Exactly. Peer-to-peer lending, automated insurance payouts when specific conditions are met. Faster, cheaper, maybe even fairer transactions. It's a massive potential shift.
Demystifying cryptocurrency creation, value, storage, and risks.
Okay, let's pivot a bit now and zoom in on cryptocurrency itself. We've talked a lot about blockchain, the tech underneath, but what is crypto fundamentally, and how does it actually, come into existence?
Right, so cryptocurrency is basically digital or virtual money. It's built on and secured by a blockchain, and key point again, there's no central authority like a government or a central bank controlling it.
Unlike the US dollar, where the Fed manages supply.
Exactly. With crypto, the supply, how new coins are made, that's governed by its specific consensus mechanism, the proof of work, proof of stake we discussed. It distributes control among the users, the network participants.
So how it's created really depends on which mechanism that specific crypto uses.
Precisely. For proof of work coins like Bitcoin, new coins are mined. That's the reward miners get for solving those complex math problems and adding new blocks to the chain.
Okay, mining creates new coins.
For proof-of-stake coins, it's a bit different. Individuals forge or mint new blocks by staking their existing coins. They typically earn transaction fees and sometimes newly created coins as a reward. PS is generally faster, uses less energy.
And incentivizes holding on to the coin, right, to stake it.
Exactly. It aligns the incentives of the validators with the health of the network.
Okay, this brings up a really big question, one I think a lot of students grapple with. How does this digital stuff with no physical backing like gold bars in a vault actually have value? It feels kind of abstract.
It is abstract, but so is the value of a lot of things, right? Even fiat currency relies on trust. For Bitcoin specifically, its value comes from a few places. One is scarcity. There's a hard cap. Only 21 million Bitcoin will ever exist.
Okay, limited supply.
Then there's its utility. It can be used as a decentralized medium of exchange. There's its market value, driven purely by supply and demand from investors and speculators. And honestly, a big part is just the collective belief that it has value.
The network effect, almost. People believe it has value, so it does.
To a large extent, yes. For other cryptocurrencies, especially ones like Ethereum, value also comes from their blockchain's ability to do more, like run those smart contracts. Developers need the native crypto, like Ether, to pay gas fees.
Ah, transaction fees. We'll get to those.
Right, so there's functional demand. And with POS coins, you can use them in apps, games, or lend them out to earn more through staking.
Yeah.
So multiple sources of potential value, but yeah, it's not tied to a physical asset.
So if it only exists on computer networks, how do you actually use it? Buy stuff? And maybe more importantly for anyone thinking of getting involved, how do you keep it safe? Storage seems like a big hurdle.
Critical questions. So individuals, companies, they buy and sell crypto, mainly through specialized platforms called wallets and exchanges. Now, it's crucial to understand you don't technically store the crypto itself, like coins in a piggy bank.
What do you store then?
You store the keys, specifically your private key. This is the secret piece of code that proves you own the crypto associated with your public address and allows you to spend it. Think of it like the password to your digital vault.
Okay, so the keys are everything, and those are stored in a crypto wallet.
Typically, yes. Your public key is like your account number. You can share it freely to receive funds. Your private key is secret lose it, and you lose access to your crypto forever.
Wow. Okay, so wallets aren't like my leather wallet. They're key managers. What kinds are there?
That's a good way to put it. Key managers. There are basically three main types, each with different security and convenience trade-offs. First, hardware wallets. These are physical devices, often like a USB stick. They keep your private keys completely offline, which makes them very secure from online hacking. Usually protected with PNs, maybe biometrics.
Downside.
You could lose the physical device or it could get damaged.
Right, makes sense.
Yeah.
Second type.
Online wallets, often called hot wallets. These are usually smartphone apps or web-based services, super convenient for quick transactions. But they're connected to the internet, so they're only as secure as any software. Vulnerable to hacking if your passwords or device security are weak. Two-factor authentication is a must here.
Okay, convenience versus security. And the third?
Paper wallets, sometimes called cold storage. This is literally printing out your public and private keys, maybe QR codes, and storing that piece of paper somewhere incredibly safe, like a safety deposit box.
So totally offline, unhackable online.
Exactly. But very inconvenient if you want to actually, use your crypto frequently. And you have to protect that piece of paper like gold.
Okay, different options for different needs. And what about exchanges? How do people trade this stuff?
Exchanges are basically online marketplaces where people buy, sell, and trade cryptocurrencies. They function a lot like stock exchanges or foreign currency exchanges.
Different types here, too?
Yep. You have your traditional cryptocurrency exchanges, think Coinbase, Binance. They act as intermediaries, matching buyers and sellers, holding funds temporarily, usually charging a small fee.
Like a stock exchange.
Pretty much.
Yeah.
Then you have peer-to-peer, P2P exchanges. These platforms connect buyers and sellers directly without holding the funds themselves. Fees are often lower, but you need to be more careful about who you're trading with.
Okay, more direct, maybe slightly riskier.
Potentially. And finally, cryptocurrency brokerage firms. These work like traditional brokers. They buy and sell crypto on behalf of clients, usually charging a fee or building it into the price spread.
Got it. Now, the scary part. This all sounds exciting, lots of potential, but we hear constantly about scams, hacks, and just wild price swings. What are the really big risks students need to be aware of before even thinking about getting involved?
This is absolutely critical, and yeah, the risks are very real. Our textbook stresses this. Let's break them down.
Okay.
Scams and fraud are rampant. You need to watch out for pump and dump schemes. Insiders hype up a low-value coin on social media, create a buying frenzy.
Drive the price way up.
Then they dump all their holdings at the peak, crashing the price and leaving everyone else holding worthless bags.
Nasty.
Very. Then there's the rug pull. Developers create a new crypto project, maybe with a slick website, get people to invest,
Sounds exciting.
and then they just disappear. Delete the website, drain the liquidity pool, vanish with all the investors' money. The rug is pulled out from under everyone.
Ouch. That's brutal.
It is. And another really insidious one is the pig butchering scam. Often starts subtly, maybe on a dating app or social media.
How does that work?
Scammers build trust, a relationship sometimes, then start talking about amazing crypto gains they're making. They lure the victim into investing on a fake platform they control. It looks real, maybe even shows fake profits.
Uh-oh.
Until the victim tries to withdraw. Then suddenly there are fees, problems, or the scammer just vanishes with everything. They fatten the pig before the slaughter. Really predatory.
So, okay, those are scary. What about hacking?
Hacking is a risk too. While big exchange hacks get headlines, they're actually less common for individual losses. More often, it's social engineering.
Tricking people.
Yeah, phishing emails, fake login pages, malicious links that trick you into revealing your private keys or passwords, giving hackers access to your wallet. Vigilance is key.
So protecting your keys and passwords is paramount.
Absolutely. And then there's perhaps the biggest financial risk for most people, volatility.
The price swings.
Extreme price swings. Bitcoin, for instance, is very liquid, has a huge market cap, but its value isn't tied to company profits or physical assets. It's driven by sentiment, adoption, regulation, news.
And that means
It can gain or lose huge percentages of its value incredibly quickly. It's a very high-risk, speculative asset class. You should never invest more than you can truly afford to lose.
the diverse world of digital assets, coins, tokens, and stablecoins.
All right, let's get a bit more granular now with the different types of digital assets out there. We hear coin, we hear tokens, sometimes wrapped assets. What's the actual difference? It can be pretty confusing for students.
It absolutely can be. Getting the terminology right is important. So here's the key distinction. Cryptocurrency coins operate directly on their own native blockchain. Think Bitcoin on the Bitcoin blockchain, Ether on the Ethereum blockchain.
So the coin is the native asset of that specific chain.
Exactly. When you send Bitcoin, you're just changing ownership records directly on the Bitcoin ledger.
Okay, coins live on their own blockchain. What about tokens?
Tokens are different. They don't have their own blockchain. Instead, they are built on top of an existing blockchain platform, most commonly Ethereum.
So they're like applications running on the main chain.
That's a good way to think of it. They represent some kind of asset or utility, maybe membership, voting rights, or an in-game item. You usually buy them with the native coin, like Ether, and they can be transferred between users on that same blockchain.
Got it. Coin is native, token runs on top. Now, what about wrapped assets? That sounds complicated.
It's a clever workaround, actually. Let's say you have Bitcoin, but you want to use its value in a DeFi application running on the Ethereum blockchain.
Bitcoin doesn't naturally work on Ethereum, right?
Right. Different chains, different rules. So you use a wrapped coin, like wrapped Bitcoin, WBTC. How it works is you lock up your actual Bitcoin with a custodian.
A third party.
Often, yes. That custodian then issues an equivalent amount of WBTC, which is compatible with the Ethereum blockchain. It's an ERC20 token. It represents your locked Bitcoin, one-to-one.
So it lets you bridge assets between chains.
Exactly. It unlocks a lot of liquidity. The trade-off, though, is you're reintroducing a bit of centralization because you have to trust that custodian holding the original Bitcoin.
Interesting point. Okay, and gas fees. We mentioned those.
Yeah.
What exactly are they and why the weird name?
Yeah, gas. It's basically just the transaction fee you pay to get anything done on certain blockchains, most famously Ethereum.
Why do you have to pay?
Because processing transactions, running smart contracts, it all takes computing power from the network validators, miners or stakers. Gas fees are how you pay them for their work.
Okay, compensating the network.
Right. The fee amount varies based on network congestion, how busy the blockchain is. It was originally priced in tiny units of ether called GWEI, and the concept of needing fuel or gas to power the operations just stuck.
So gas fee is just the cost of using the network.
Pretty much, yeah, for chains like Ethereum.
Okay, let's categorize some of these major cryptos. We hear about store of value coins. What defines that category?
Store value coins are digital assets primarily intended to hold their value or ideally appreciate over time, like digital gold or maybe digital fine art. A key characteristic is usually a limited or predictable supply that can't be easily inflated.
So scarcity is key. Examples.
The classic example is Bitcoin, BTC. Created back in 2009 by the mysterious Satoshi Nakamoto, designed explicitly as this alternative currency, free from government control, with that fixed 21 million coin limit.
The original.
The OG. Then there's Litecoin, LTC. Charlie Lee created it in 2010, aiming for faster transaction times than Bitcoin, often positioned as the silver to Bitcoin's gold.
Okay, faster silver.
And, maybe surprisingly, Dogecoin, DOGE. Fits here for many people now. It started literally as a joke, a meme mocking crypto speculation.
I remember that.
But somehow, fueled by social media and celebrity endorsements, it gained a massive market cap and a community that treats it partly as a store of value, partly just for fun. Very strange trajectory.
Definitely unconventional. Okay, beyond just storing value, we have cryptos focused on enabling those smart contracts and applications. Ethereum is the big one here, right?
Absolutely. Ethereum ETH. While some people definitely hold Ether as a store of value, its primary design purpose was different. It was built to be a platform, a sort of world computer.
A platform for what?
For developers to build and run decentralized applications, dApps, and smart contracts directly on its blockchain. We talked about smart contracts, those self-executing agreements. Ethereum made them widely accessible.
So it's more like a foundational layer for other things.
Exactly. It's still the most dominant platform for smart contracts, using its ERC standards like ERC20 for tokens, ERC721 for NFTs, to let developers create all sorts of assets and applications within its ecosystem.
Okay. Now, you mentioned Ethereum used proof of work initially, which could be slow and expensive. That led to newer blockchains focused purely on speed and efficiency for dApps, using proof of stake, right?
Precisely. As dApps got more complex, the need for faster, cheaper transactions became critical. POS blockchains were designed to meet that need.
What are some key examples students should know?
Well, there's Binance Coin, BNB, and the Binance Smart Chain, now called BNB Chain. Binance started as an exchange on Ethereum, then launched its own high-speed chain using a form of proof of authority stake. We're talking potentially 60 transactions per second compared to Ethereum's much slower rate back then with very low fees.
Big difference.
Huge for usability. Then you have Cardano, ADA. It's another major POS blockchain, really focused on research-driven development, security, and sustainability. It boasts around 250 transactions per second, also with super low fees. Its native crypto is ADA.
Okay, Cardano.
And Solana, SOL. This one really made waves because of its sheer speed. It uses a unique consensus mechanism involving proof of history alongside POS, claiming capabilities of up to 65,000 transactions per second.
65,000.
Yeah, incredibly fast. And transaction costs are fractions of a penny. That speed has made it super popular for things like NFTs and high-frequency dApps like decentralized exchanges.
Wow, the speeds are incredible. Okay, one more category. Stablecoins.
Yeah.
The name suggests they solve the volatility problem we discussed. How do they actually work?
That's exactly their goal, to minimize volatility. What's fascinating is how they achieve this. They aim to be pegged or tethered to a more stable asset, usually a major fiat currency like the US dollar, sometimes commodities like gold.
Pegged. So one stablecoin equals $1 ideally.
That's the most common goal, yes. And there are three main ways they try to maintain that peg.
Okay.
1. Fiat collateralized. This is the simplest to understand. For every stablecoin issued, the company holds 1 unit of the corresponding fiat currency, like $1 USD, in a real bank account or similar reserves. They often get audited to prove it.
So backed by real dollars.
Supposedly, yes. That's the claim. 2. Crypto collateralized. These are backed by reserves of other cryptocurrencies. Because crypto is volatile, they usually require over-collateralization, meaning they hold, say, $2 worth of Ether for every $1 stablecoin issued to absorb price swings.
Okay, using crypto to back crypto, but with a buffer.
Right. And 3rd, algorithmic stablecoins. These often don't rely on reserves at all. Instead, they use complex smart contracts and algorithms to automatically manage the supply of the stablecoin, buying or selling it on the open market to keep its price pegged to the target, like $1.
Wow, that sounds complex and maybe risky.
Very complex and historically, yes, quite risky. Some major algorithmic stablecoins have lost their peg dramatically.
Okay. Can you give us some examples of well-known stablecoins in these categories?
Sure. For fiat collateralized, the biggest are Tether, USDT, and USD Coin, USDC. Both aim for a 1.1 peg with the US dollar. Tether's reserves have faced scrutiny over the years, while USDC, issued by Circle, is generally seen as having more transparent backing. Both run on multiple blockchains.
Okay, USDT and USDC, the big ones.
Yeah.
Algorithmic.
Historically, Terra USD was a major one. It used an algorithm linked to its sister coin, Luna, to maintain its peg. As I mentioned, its collapse was a huge event in crypto. It highlights the risks of purely algorithmic systems, again, adhering to sources' description of mechanism, not just the outcome.
Right. Any crypto collateralized examples?
DAI is the main one here. It's created by MakerDAO on Ethereum, pegged to the US dollar, but it's backed entirely by other crypto assets locked in smart contracts, primarily Ethereum, and it's heavily over-collateralized. It's considered one of the most truly decentralized stablecoins.
The future is decentralized DeFi and NFTs.
Okay, we've talked about smart contracts, we've talked about dApps. Let's connect this to the really big buzzword. Decentralized finance, or DeFi. For our business students listening, what exactly is DeFi, and what's its potential impact on the traditional financial world?
Right, let's zoom out again. So you have traditional finance, TradFi banks, brokers, insurance companies, all centralized organizations acting as intermediaries, right?
Yep, the status quo.
DeFi aims to rebuild those financial services, but using smart contracts on blockchains. The goal is to cut out those intermediaries entirely.
Eliminate the middleman, like we discussed with smart contracts.
Exactly. This means reducing transaction fees, increasing transparency, and removing the need to trust a central party. It enables peer-to-peer lending, borrowing, trading, earning interest, all directly between users connected via the internet and the blockchain.
So, potentially a more open, efficient financial system. What's the real potential impact here?
Well, DeFi proponents argue it could eventually challenge or even replace many functions of traditional banks. They see it as more trustworthy because the rules are code, more efficient due to automation, and cheaper due to fewer overheads.
And accessible.
Hugely accessible. Because it's permissionless, it avoids certain kinds of discrimination present in TradFi, but maybe the most profound impact. Reaching the unbanked, there are about 1.5 billion people globally without access to traditional banking.
Wow.
DeFi could potentially provide them with financial services through just a smartphone and an internet connection. And that opens up a massive underserved market and could have huge developmental implications.
That's powerful. And it sounds like smart contracts are truly the engine driving all of this. You used the vending machine analogy earlier.
That's a great analogy. A smart contract is like that vending machine.
Right.
If you put in the correct crypto amount, the cause, then the digital asset or service is automatically delivered. Effect. No cashier needed, no negotiation, just automated execution based on pre-agreed code. That's the core of DeFi.
Okay. We also hear about DAOs, decentralized autonomous organizations. How do they fit into this picture?
DAOs, pronounced DAOs, are kind of like online investment clubs or digital co-ops, run entirely by code and community consensus.
How so?
Individuals pool funds together for a specific purpose, maybe investing in startups, managing a DeFi protocol, funding artists. They use smart contracts to manage the treasury, and, crucially, voting mechanisms where token holders collectively decide on policies and how funds are spent.
So governance by the community, not a CEO or board.
Exactly. Decentralized governance is the key idea.
And dApps, decentralized applications, are they just another name for DeFi protocols?
Not quite. dApps, or dApps, is a broader term.
Yeah.
Think of them like the apps on your phone, but running on a blockchain, usually accessed anonymously via a crypto wallet.
Okay.
DeFi protocols are a type of dApp focused on finance. But you can have dApps for gaming, social media, identity management, all sorts of things. The idea is they could eventually offer alternatives to many centralized apps we use today, potentially with lower costs, more user control over data, and greater censorship resistance. Currently, yeah, finance, gaming, and digital collectibles like NFTs are the most popular uses.
Perfect segue. Let's talk NFTs, non-fungible tokens. Huge buzz a couple of years ago. What exactly are they beyond, those Bored Ape pictures?
Right. So NFTs are unique digital assets whose ownership is tracked on a blockchain. While often associated with digital art, like those apes, an NFT can represent ownership of almost any unique item, digital or even physical.
Okay, unique ownership. Where do they mostly live?
Predominantly on the Ethereum blockchain, often using a specific token standard called ERC-721, which is designed for unique items. A smart contract essentially wraps the digital file, the art, the music clip, the virtual land deed, creating a unique token that proves ownership and grants certain rights to the holder.
So it's more than just having the image file. You have the blockchain proof of ownership. What makes it non-fungible? That's a weird word.
It just means unique and irreplaceable. Think about fungible things first. A dollar bill is fungible. I can swap my dollar for your dollar, and they're identical in value and function. Same with one Bitcoin versus another Bitcoin.
Interchangeable.
Exactly. Non-fungible means it's not interchangeable. Each NFT is unique, like an original painting or a specific concert ticket for seat A1. You can't just swap one NFT for another and have the exact same thing. Each has its own distinct identity and metadata recorded on the blockchain.
Okay, that makes sense. Uniqueness is key. But why do they have value? Especially digital art that anyone can technically copy. Is it just hype?
That's the million-dollar question again. Fundamentally, like traditional art or collectibles, NFTs have value because buyers believe they do and are willing to pay for them.
So subjective value?
Largely, yes. People buy them for different reasons. To support a digital artist they like, for the social status or bragging rights of owning a particular piece, especially from a famous collection, or purely as a speculative investment, hoping the value will go up.
Like flipping baseball cards, almost.
In some ways, yeah.
Wow.
And just like collectibles or speculative assets, the NFT market is incredibly volatile. Huge booms, huge busts.
So looking ahead, what's the prognosis for NFTs? Are they just a fad like Pogs or Beanie Babies, or are they here to stay in some form?
Well, opinions are really divided. Some definitely see the initial hype as a short-term speculative bubble that largely burst, similar to collectibles crazes of the past.
Okay.
Others believe that the concept of provably scarce, authentic digital art and unique digital assets will retain value, maybe even appreciate, especially as our lives become more digital.
And the metaverse connection.
Right. Most observers agree that if or when the internet evolves into a more immersive metaverse environment, NFTs could become really important. People might use them to own virtual land, customize avatars, display digital art in their virtual homes.
So digital property rights in virtual worlds?
Exactly. That could give them long-term utility. But the caveat remains. For anyone thinking of investing, especially students, approach the NFT market with extreme caution. The volatility is significant, and it's very easy to lose money. Outro.
Wow. Okay, that was quite the deep dive into blockchains and cryptocurrencies. Hopefully you listening now have a much more solid handle on this whole rapidly evolving field.
Yeah, we covered a lot from the base tech, the different types of assets, the applications.
To the potential and, importantly, the risks. And it's all grounded in the material from your Connect Master, Management Information Systems textbook by Tedmon and Wilhelm.
We really see how these ideas, these concepts, are actively reshaping business. Supply chains, finance, even art and ownership are being rethought.
Absolutely. And for you, our Dr. Sam Pak College of Business students, and really anyone heading into the business world, this knowledge, it's not just theory, it's becoming increasingly vital for navigating, well, the future.
Couldn't agree more.
So to keep this conversation going, we've got a question for you all. Given everything we've discussed, the potential, but also the scams, the hacks, the sheer volatility, would you personally invest in cryptocurrency or NFTs right now?
Yeah. Curious to hear your thoughts.
Let us know why or why not in the comments below. We'd love to see what you think.
Definitely.
And remember, if you want to stay ahead in this dynamic world of MIS and keep learning with us, please do like, subscribe, follow, share this deep dive.
Engage with the community.
Exactly. Join the conversation. Thanks so much for tuning in.
Thanks, everyone.
We'll see you on the next deep dive.